Equities priced in a ceasefire every time one was rumored. The Strait of Hormuz priced in nothing until tankers moved, and this week 5 did. That gap between financial market signals and physical market reality is the defining structure of the week ending April 12th. The S&P 500 logged its 7th consecutive day of gains. March CPI came in at 3.3%, its highest reading since April 2024. Gas prices posted their largest single-month surge since the Bureau of Labor Statistics began tracking the data in 1967. And as of Thursday, traffic through the world's most consequential oil choke point was still running at less than 4% of its pre-war volume. The ceasefire announced Tuesday evening did not reopen the strait, it merely formalized Iran's leverage. Tehran agreed to a minimum of 15 ships per day and delivered 5. Every vessel still requires military approval before transit. Crews receive routing instructions to avoid Iranian-laid mines, and Iran has begun collecting tolls payable in Bitcoin and stablecoins. Analytics firm TRM Labs confirmed the Revolutionary Guard Corps collected up to $2 million in cryptocurrency since mid-March. Iranian oil, which normally trades at a $10 discount to Brent, sold at a $3 premium in China and a $7 premium in India during the disruption, meaning Iran's coffers were being replenished by the crisis it created. Brent settled near $96 on Thursday, down from $116 at Tuesday's peak, when U.S. strikes on Kharg Island, Iran's main export hub, briefly accelerated the price climb, but still roughly 40% above last year's average. The Strait's physical infrastructure compounds the timeline. Insurance clearance, mine clearance confirmation, and operational security checks must all precede tanker movement. The airline industry's own assessment was direct. The International Air Transportation Association's head said the jet fuel supply disruption is comparable to 9/11 in scale, and even a full Strait reopening would take months to normalize refining capacity and fuel prices.
The energy shock arrived on top of a monetary policy framework that cannot absorb it. March CPI rose 0.9% month-over-month, triple February's rate, with energy accounting for nearly 3/4 of the increase. Annual headline inflation reached 3.3%, yet core CPI, stripping out food and energy, rose just 0.2% monthly and printed a tenth below forecast. Services inflation was contained. Shelter inflation matched its lowest level since 2021. This split leaves the Fed with no clean policy response. Acting on the headline risks tightening into a supply shock. Ignoring it risks entrenching inflation expectations, now running at 4.8% in the University of Michigan survey, up a full percentage point in a single month. Core PCE, the Fed's preferred gauge, had already been stuck near 3% for 3 consecutive months before March's energy surge hit. On a 3-month annualized basis, it was running at 3.7%. GDP growth was revised down again to 0.5% annualized for Q4 2025, from an initial 1.4% estimate. The Atlanta Fed's GDP Now model put Q1 2026 real growth at 1%. The labor market's own signal was equally constrained. The hiring rate fell to 3.1% in February's JOLTS data, matching April 2020. Fed officials diverged publicly. Cleveland Fed President Beth Hammack said a rate hike is possible this year if inflation remains persistently above target. Chicago Fed President Austin Goolsbee said a stagflationary recession from an oil price rise would be the worst outcome. Prediction markets now assign a 40% probability to 0 rate cuts in 2026.
While the macro picture compressed, the AI investment cycle moved in the opposite direction, and the two are now competing for the same resources. Amazon CEO Andy Jassy disclosed in his annual shareholder letter that AWS AI services generate over $15 billion in annualized revenue, with $200 billion in planned capital expenditure for 2026, nearly entirely directed at AI infrastructure. Meta committed $21 billion to CoreWeave data centers, layered onto a prior $14.2 billion agreement, bringing Meta's total committed spend to $35.2 billion through 2032. Anthropic, whose annual revenue run rate crossed $30 billion this quarter, up from $9 billion at the end of 2025, signed its own multi-year CoreWeave deal the following day. CoreWeave stock surged 13% Friday. 9 of the top 10 AI model providers now run on CoreWeave infrastructure. The structural tension is leverage. CoreWeave carries $21 billion in debt and raised another $3 billion to fund the Meta deal, with no margin for utilization shortfalls. Broadcom gained 4% after signing a 5-year AI chip and networking deal with Alphabet, and expanding a separate Anthropic agreement providing 3.5 gigawatts of TPU compute beginning in 2027. The constraint underneath all of this is energy.
Data centers require natural gas. Natural gas output from the conflict zone is down 20%. Qatar has frozen LNG exports. AWS CEO Matt Garman confirmed drone strikes damaged Amazon data centers in Bahrain and the UAE, with services still unavailable. The helium crunch from Qatar, which supplies over a third of global supply, is beginning to squeeze semiconductor manufacturers. The AI build-out is generating demand the current energy system cannot easily absorb, and the demand does not pause for a ceasefire. Tesla entered its 8th consecutive week of losses, down roughly 25% in 2026, the only Magnificent Seven member absent from the week's broader tech rally. Yet retail investors poured $256 million into Tesla shares over 5 trading days, according to Vanda Research. The divergence reflects a fundamental disagreement about what the stock is. Q1 deliveries of 358,023 missed the analyst consensus of roughly 365,000, the second consecutive quarterly miss, while Chinese sales fell 16% year-over-year and energy storage deployments came in at 8.8 gigawatt-hours against an expectation of 14.4. JP Morgan carries a sell rating with a $145 price target, implying more than 58% downside. The bull case, Optimus robots, unsupervised robotaxi deployment, and a cheaper Model Q, has produced no confirmed delivery timelines. Retail buyers are pricing the roadmap. Institutional positioning reflects the trailing data. The gap closes on April 22nd when Tesla reports earnings. The options market is pricing significant volatility around that date, signaling uncertainty about direction, not magnitude.
The weight of evidence points toward oil remaining structurally elevated through at least the end of April, even if the ceasefire formally holds. The Strait's physical constraints, mines, approval requirements, insurance clearance, do not dissolve with a diplomatic document. Iran has also demonstrated it can extract a premium on its own exports during the disruption, reducing urgency for a rapid, binding reopening. That leaves the energy shock feeding into April's CPI reading, which will carry the first full month of war-driven price transmissions to freight, fertilizer, and aviation fuel. The Cleveland Fed's own model estimates headline inflation could reach 3.3% on a sustained basis. A second consecutive elevated reading would force the Fed's patience into open debate. The recovery scenario requires 2 simultaneous conditions: a verified, functioning Strait reopening that restores tanker traffic to at least 50 ships per day, the threshold at which oil futures begin to price normalization, and a March payrolls print or April earnings season strong enough to push recession probability back below the levels Goldman Sachs, Moody's Analytics, and EY Parthenon all raised this week. Neither condition is impossible. The 35-nation coalition the UK convened, without US attendance, could produce a framework that draws Washington back in. An AWS earnings beat or a Tesla robotaxi timeline confirmation could re-anchor confidence in the growth side of the ledger. The 2 benchmarks that carry the most weight next week are the weekly Strait tanker count and the April 22 earnings calendar, beginning with Tesla. If tanker traffic holds below 20 ships per day and Tesla delivers another set of delayed timelines, the ceasefire rally will have been the most expensive misreading of the month. If traffic climbs toward 50 and Amazon's AWS growth rate sustains above 20% with CapEx guidance intact, KA's cycle provides a partial offset to the macro pressure. The market priced resolution twice this week, once on Axios rumors and once on a formal ceasefire. The physical world delivered 5 ships both times. That is the tension heading into next week.